Hello, everybody, and thank you for joining us for today's IIF ESG webinar. We hope you're all staying healthy and safe. Our new IIF ESG webinar series is designed to promote understanding of the rapidly evolving landscape for ESG disclosure and help with alignment of efforts to measure and track climate finance. During these webinars, we look at policy and regulatory initiatives, new academic research, data providers, and of course, market trends, which brings me to the topic we have with us today. I'm very happy to have joining us for today's discussion from ING, Dan Shurey, who is Vice President, Sustainable Finance Americas. Many of you may remember Dan from his time at Bloomberg previously. I'll open up and Dan will tell us about ING's perspectives on sustainable bond and loan markets, with a particular focus on new product developments. And after Dan's presentation, we'll have a Q&A session where you can submit questions via the chat box at the bottom of the screen, the Q&A function. We'll get to as many as we can, but stick firmly to half an hour for this webinar. And just two logistical notes to keep in mind. First, this discussion's on the record and press is in attendance. A video recording of the event will be posted on our website soon after. And questions can be submitted with the Q&A prompt button at the bottom of the screen. Unfortunately, if you're joining us with the phone, you won't be able to submit questions. So Daniel, let's get started on your presentation. But first, tell us, where are you joining us from today and how are you faring in continued lockdown?
Good morning, Sonia, and thank you very much for inviting me to the webinar series. It's great to be part of this on the other side of the camera for once. So I'm joining you from upstate New York, actually. I was very fortunate to be able to be living on a mountainside for the past couple of months and actually have high-speed internet, which is faster than my typical home in Brooklyn. So everything is business as usual for me.
Wonderful. Well, I know you've got a fabulous presentation for us, so please start right up.
Sure, absolutely. So I'd be glad to talk to you today about sustainable finance, or specifically sustainable debt, on the ground as we see it from ING. There's plenty of material to go through today, so I apologize if I can't touch on everything. What I'd like to do is just give a very quick recap of what sustainable debt actually is, where we are in the markets today. I want to point to three observations that we've seen at ING in the past few months, which I think are particularly relevant and particularly important for the future of the markets. And then I'll be happy to answer any questions that you have. But I just wanted to start with this slide, this photo, because I think it sums up the sustainable finance market quite well. We see liftoff in numerous different innovations, creative structures and products that are all moving in the same direction and all moving for the same purpose, which is around furthering transparency and disclosures related to sustainability in the debt markets. And I think that this picture is a pretty good summation of that. This is an overview of the markets as we see it, broken down by the main different types of sustainable debt. So what exactly is the sustainable debt market? We see it as bonds and loans that either finance or fund sustainable projects. And we would consider these to be sustainable use of proceeds. And that's an important distinction. That's kind of bucket one. And then also those that incentivize sustainability improvement, typically in the borrower through the use of sustainable KPIs. And that's bucket number two. And we see that the various different types of sustainable debt that are listed here, from green bonds, loans, social bonds, all the way through to sustainability-linked loans and linked bonds, fit within these two different buckets. As you can see, issuance has grown every single year since the beginning, or the first principles were established in 2014. Every single year has broken volumes or broken volume records from the year before, which has been quite remarkable. And last year we actually hit $1 trillion in total outstanding sustainable debt. Again, another very significant milestone for the market. In terms of the regional breakdown, it's primarily focused on EMEA, and this is really where the market started. But we do see significant growth in both the Americas region and in the APAC region. In some ways, that these three markets are moving slightly different directions, but we do also see convergence on the horizon as well, which is a good step in the next chapter of the market. And finally, one point about these markets is that it's generally guided by voluntary principles. And we'll talk about that a little bit later on. And again, another observation that we see is that we're generally moving towards regulated standards in the definition of sustainable debt. Again, that's going to be another important chapter, in the story of the sustainable debt market. But as you can see, overall, we see diversity in different types of sustainable debt solutions. We see growth, and we see good kind of market activity, globally speaking. A little bit more of a breakdown here as to what each of those different types are. Again, to those two different categories that I mentioned, the sustainable use of proceeds, number one, and the sustainable KPIs, number two. So let's talk about the first category, sustainable use of proceeds, because this was, generally speaking, the kind of the first endeavor in the sustainable debt markets. Here we see green bonds. This is the largest portion of the sustainable debt market. It was also the first. We also see green loans and variations around things like green Schuldscheins. And then we see social bonds and sustainability bonds as well. As you can see, these four are guided by slightly different monetary principles: the green bond principles, green loan principles, social bond, and then finally the sustainability bond guidelines. And by the way, a sustainability bond is a kind of a combination of green and social. We'll talk about that a little bit later on as well. What makes the sustainable debt sustainable? Well, in this category, it's based on the use of proceeds. So for green bonds and green loans, there has to be eligible green projects, and there are non-exhaustive lists of categories or projects that would be considered to be green. And as we talked about moving more towards a regulated market, we see specific technical screening criteria and taxonomies to define exactly what is and what isn't a green project. On the social side, the use of proceeds of social projects, and on the sustainability side, it's a combination of green and social projects as well. And then just a little bit of commentary there that even though these principles are slightly different, they do follow the same pattern in which there are four core components around 100% use of proceeds, project evaluation selection, to define which projects are selected and the governance around that, the management of proceeds to ensure that it actually, that there is the correct allocation of proceeds, and then reporting both on the impact side, but also on the allocation of those proceeds. And those are roughly the kind of similar structure of those different principles. And then this second bucket here, the second category, a little bit newer. As you can see, the first established principles were in 2019 and most recently 2020 for this completely different category of sustainability-linked loans and sustainability-linked bonds. And what makes these interesting is that the eligibility isn't defined by the use of proceeds. They can be for general corporate purpose. Instead, the eligibility is defined by the KPIs that are set up against those different structures. Those KPIs can be ESG scores from third parties, or they can be company-defined ESG metrics or performance criteria, or in some cases, they can be a combination of both. So that's generally a very high-level view of how we see the sustainable debt market and these two different routes to market or ways to define what makes the debt sustainable in the first place, either the use of proceeds or the KPIs. What I wanted to do very quickly is talk about what this means in the context of investors, because at the end of the day, most of these solutions were driven by demand on the investor side. I won't go through this in a lot of detail. This will be here on the recording so you can go through this. But what I wanted to show was that there are numerous sustainable investment styles that have informed the development of the sustainable debt markets. Anything from negative screening, which is the largest in terms of assets under management, all the way through to thematic and impact investing, in which a specific mandate is around specialist environmental goals or specific, in some cases, philanthropic goals around generating social impact. This is a whole spectrum of different sustainable investment styles. And as you can see, there are examples of both, of all of these different styles on the right-hand side from public documents. This is important because, as I said, this has informed the development of these various sustainable debt solutions. We can see where we roughly see these and who has driven these sustainable debt solutions from a sustainable investing perspective. So the sustainable use of proceeds, let's remember green bonds, green loans, social bonds, and sustainability bonds. That really has been driven by impact investors. So we see specific thematic funds, impact funds, in which investors want to be able to extract environmental or social positive impact from investments. And the use of proceeds route to market is a very good way of doing that, because you can isolate that impact and you can quantify it, and it's something that investors really like to see. And that's why we see numerous green bond funds or SRI funds in the fixed income space that have a very large appetite for things like green bonds, and that's really driven the market. The second category, the sustainable KPIs, that isn't so much driven by impact because the use of proceeds aren't, generally speaking, don't necessarily have to be for specific projects. Instead, the sustainable KPIs is driven by investors who want to engage with clients or with portfolio companies. They want to generate better scores. They want to generate better ESG performance across the entire entity, not just at the bond or the loan level. And so this incentivization process is a good way to engage. And we see that as a very popular route to engage with companies and to improve the overall ESG performance of portfolios. And that's why we see this slight differentiation between these two different categories of sustainable debt. They are merging. We do see that actually investors aren't exclusively fitting into any of these buckets anymore. Investors are looking for impact, but they're also looking for a wider connection to the ESG strategy. And so we're starting to see these investment styles merging somewhat as the market mainstreams. Moving on, let's look at some of the observations we've seen in the market so far. I've been given a very, very difficult task of picking out 3 points of a market that is extremely large and dynamic, and there are so many things happening, so many ways to slice and dice the data. It's very difficult to really, to distinguish everything, and that's very challenging for me to do because I follow the market and I want to talk about all the changes. But what I'll do today is talk about 3 high-level things that I think are very important from the perspective of who is issuing, and that's one way to look at it. So this chart here basically is issuance of sustainable debt through time, broken down by the type of issuer. Is it a sovereign issuer, supranational? Is it a corporate issuer, or is it, for example, a government agency? There are 3 things that I wanted to point to. Number 1, that grey bar, the corporate issuance, has been growing very, very steadily through time and quite rapidly in the last couple of years. Whilst corporate issuance was a very small part of the market in 2014, you can see that grey bar is pretty small. By 2019, it was essentially half of the market, as more and more corporate issuers are engaged in the market and actively issuing sustainable debt. That's very important, and we'll talk about that a little bit later. The second point is the shift away from project level, which is that green bar, towards portfolio level, which is more on the corporate side. Basically, what that means is rather than issuing single project bonds for each individual green asset, you're now issuing everything at the portfolio level. And we'll talk about that a little bit later on and why that's important. And thirdly, we've seen a surge in social issuance, the S within ESG. And that has primarily been driven by sovereign, supranational, and government agencies, which we see that resurgence, especially in 2020, but now we're starting to have the corporate play as well. So let's talk about these 3 different shifts, these 3 different observations, and maybe go into a little bit more detail as to what's happening. Number 1, from the corporate angle, why is corporate issuance growing as much as it is? One of the reasons is that this second category of sustainable debt type, this sustainable KPI linked sustainable debt, has become very popular. It's the gray area here. You can see that KPI driven sustainable debt is growing very rapidly, very largely in 2019, for example, with the onset of the sustainability linked loan principles and more recently the sustainability linked bond principles. A lot of corporates like this approach to sustainable debt. Why? Because it's general corporate purpose. They don't have to find specific green projects for every dollar that's raised by the capital. Instead, the money can be put towards general corporate purpose with a KPI linkage to it. So it allows a degree of flexibility for corporate issuers, and it has opened up the market pretty substantially for that reason. It also introduces the idea of a pricing mechanism, the first time in which a sustainable debt solution actually has explicit pricing differentials based on whether or not you meet those ESG KPIs. That's a game changer because that allows new conversations with companies that maybe aren't so engaged in sustainability, but are engaged in the idea of saving money. So we've opened up a whole new conversation with all these investors, and this is their route to market. And then I want to touch very quickly on the fact that we now have sustainability-linked bond principles. This was just a guideline process that came out just this month. And this is going to be a very important stage or new chapter in the market as we see that sustainability-linked concept being translated primarily on the loan side now, but moving more towards the bond side for bonds with general corporate purpose. That's going to bring a whole lot of scale, and that's going to help to really drive the market into the future with significant issuance, because there is now an established framework as to what defines a sustainability-linked bond. On to observation 2. This is bear with me, this looks a little bit complicated, but what I want to say here is that we've seen a shift from project level sustainable debt through to portfolio level sustainable debt. What that means is rather than creating or building or constructing a green asset, say for example a wind farm, and then issuing a green bond to allocate the proceeds to that wind farm, now what we're seeing is a portfolio approach. What that essentially means is that companies are able to amass all of their expenditures and investments related to green or social or both into one large portfolio. And they build and they grow that portfolio through time. They then issue multiple green bonds or green loans or social bonds or whatever it might be off of that portfolio through time, which basically means that they're able to access the market continuously. They're able to scale. They're able to also combine multiple green projects from different business lines, from different jurisdictions or different subsidiaries of the company, and they're basically able to access economies of scale. That's really important because that allows companies to kind of return to the market, not just access once and then be done, but allows them to return to the market. And it builds a much better connection between the overall sustainability strategy of the company and their financing strategy, because the two are much more kind of aligned together with that portfolio and that the outstanding green proceeds or sustainable proceeds approach. That's really important because, yeah, as I said, it's a way to kind of really combine those two strategies together to bring about scale, and it's really helped the corporate bond issuance, the corporate issuers access the green bond market in a way that they haven't been able to before. And then the third observation, which is the next slide, is the surge in social issuance. So up until now, we've had the social bond principles for many years. I think at this point it's 3 years, but this has always been a little bit of a laggard in terms of issuance. A couple of things have happened that have really helped to drive the market. Of course, the COVID-19 crisis has really brought this into the spotlight. But more specifically, there's been updated guidance from the ICMA, the International Capital Markets Association, which convened these various principles to help define the eligibility of any efforts related to COVID. Now that could be, for example, pharmaceuticals who are building vaccines. That could also be manufacturers who are building ventilators, or it could also, on the finance side, be insurance companies who are covering the cost of healthcare related to COVID complications. So that's a really important part in helping tangibly define social projects in a way that is very relatable to a lot of companies that wouldn't have been this time last year. And that's really helped to drive this market, both on the supranational side, but also on the corporate side, as well as we saw some issuance from pharmaceuticals that actually specifically mentioned COVID. And then more recently, just in June this year, we've seen an updated social bond principles, which essentially widens the target population of who a social project should be targeted to. It also expands on examples of social projects across multiple different categories, including food, employment and income disparities, to be able to make the social language far more relatable to everyday companies and not just those that have a philanthropic cause. That's very important, and that's really going to help define the market for corporate issuance further. So I'll leave it there. I know I'm coming up into time, so I'll be happy to take any questions on it.
Thank you very much, Dan. That was absolutely fascinating. And you've covered quite a lot of ground here. Some of the questions that we have coming through are quite interesting here. One asks about green bonds specifically, saying most green bonds are focused on climate mitigation measures, so fixing the problem. But what is the future of resilience or adaptation focused bonds or instruments? Are these under development?
That's a fantastic question. And yes, it's very much been aligned with climate mitigation. And that is moving in step with things like the EU taxonomy, in which technical screening criteria has been established for climate change mitigation, but not yet for things like resiliency and other things like circularity and biodiversity. So yes, we do see this as a very important part of the pie, and we do see it as actually a good way of expanding potential use of proceeds and building out a much larger base of issuers. As an example, actually just today, ING announced that we're a sole structuring advisor for a green finance framework for a water company that very much focuses on resilience of water infrastructure. So not so much on the mitigation side, but also on the adaptation, looking at how we make water more affordable in scarce regions, especially with the changing climate. And this is something that we see a huge demand from investors from. So we do certainly see that moving in this direction as we see a broader scope of potential environmental objectives.
Right, exactly. And you mentioned sort of building out the markets and scaling up and expanding the issuer base. What are some of the big challenges that you see issuers facing there?
That's a very good question. Yeah, I think traditionally we saw a lot of companies struggle to identify specific projects that they could then allocate proceeds to. So if you're a utility, it's somewhat easy because you can look at the very large utility scale wind and solar projects, and it's very easy to identify dollar spend or expenditures related to those projects. If you're a company that's maybe in the service industry, or you're looking at the supply chain, it's very difficult to be able to identify those eligible expenditures or investments in a way that makes would make for a meaningful issuance for a green bond, for example. And a couple of things have happened to kind of ease that. Number one is this portfolio approach. That portfolio approach it allows you to kind of identify and add up all those projects across value chains, and then track them through time in a simplified way. And then the second is the fact that we're seeing this expanded eligible project criteria. So on the social side, we saw things like food scarcity and income inequality, larger target population, which allows you to maybe access different expenditures related to other social causes, not just environmental causes. And then finally, the fact that we have the KPI linked market, in which you don't have to specifically allocate it to expenditures. It can be for general corporate purpose. Again, that's a way in which this challenge has been overcome.
So we have a number of questions through on your reference to transition bonds, bonds that might help polluters in mining and oil and gas to fund projects that transition them over time. How well is this market likely to develop? Does it really have a lot of potential? What do you see as the outlook for transition bonds?
It's on everyone's mind at the moment. There are a number of sectors, the harder to abate sectors, that there is significant potential for issuance of sustainable debt that maybe wouldn't necessarily meet the criteria of a green project. Notwithstanding, it's still important. It's still important to understand how these companies, these harder to abate sectors, are able to contribute to the transition. And I think that this dialogue needs to be expanded. It's something that's been taken very seriously by, for example, the ICMA. There's a working group around defining guidelines for transition finance. And that's something that I expect to see future developments on and clarifications on, be it through maybe principles or just establishing guidelines related to existing green bond principles. But it points to the fact that this is no longer on a case-by-case basis. It's no longer looking at just green projects. Investors need to understand the overall sustainability strategy of a company, regardless of the sector, regardless of where they are right now. They need to understand what their long-term transition looks like, how science-based that transition is, how that benchmarks against their existing peers or their industry group. And that will be the defining point at which we'll be able to establish better guidelines for transition finance. The term is only going to become more popular, and we see this as a pretty crucial step in the development of the sustainable debt markets.
Mm. So you mentioned the kind of understanding sustainability strategy, and there are a couple of questions here that touch on that point. One is around kind of the availability of data and disclosure. How do you, for example, in the case of social bonds, which arguably we have even less information, data pertaining to social issues than we do to environmental issues. So how do social bonds avoid the trap of social washing, like greenwashing?
It's a fantastic question. And I think that it's something that the market is still having to define and having to really put specific criteria on. I think the establishment of third-party data sets, of benchmarks against specific target populations to understand exactly what is a social population that requires some sort of, I guess, that needs to be addressed through social projects and social bonds. We're not quite there yet. I think that with volume and with multiple issuances, we will start to see a kind of a movement and a kind of I guess I think that we'll start to see more of a harmonization in social standards. It's also very important for things like the EU taxonomy, which up until this point has very much been focused on the environmental objectives, but also the do no significant harm criteria also very much is related to social aspects as well. So at the end of the day, climate issues are social issues, and so this is something that we're going to have to address. But given that this is such a smaller market, I think that there's still some steps that need to be taken.
Yes, and I think you raise a very good point. The availability of data in this area in particular, but also on broader ESG issues is a tremendous challenge for the industry. So lots of good initiatives out there. The Sustainable Data Alliance for one, looking to address these issues. So something to watch going forward. We've got a couple of questions here around sovereign issuance. And one is, how do you see prospects for sovereigns in this market? Why aren't we getting more, sovereign issuance? And do you see prospects for more issuance of ESG linked bonds without necessarily linking the use of proceeds, which can be challenging for a sovereign issuer?
So yeah, so sovereign issuance isn't exactly my area of expertise, so I'm just going to have to put that out there and say that I'm focused much more on the corporate market. That said, I think that we're at the beginning stages of understanding how COVID-related efforts from governments can really play a very significant role in the development of the sovereign sustainability bond market. And I think that we'll certainly see much more of that. And I also think that, interestingly, on the linkage side, as we see more and more companies looking for government help, maybe for bailouts for certain industries that have been affected by this crisis, what is the possibility that we can assign sustainability-linked metrics to companies that are looking for government help or public help through funds, be it at the kind of the government level or the supranational sovereign level? So I see a huge opportunity here, especially related to COVID, not just because of COVID, but I think that will be a very good springboard for ongoing environmental and social issues. I think this is just very much first to mind at the moment. And I think there's also a huge opportunity for the sovereign market to get very creative around finding new tools and new solutions that fit their specific financing needs, but also their strategies they're implementing to align to things like Paris goals or to address crises that we see at the moment, like COVID, for example. So there's a huge opportunity there. I think that we're just at the beginning stages of it.
I think the use of proceeds is an issue, and it's also the case with sort of emergency financing that's being dispensed to countries to help with COVID pandemic response. And you're getting a message from the people providing the finance. We understand it's a tough time, but save the receipts. Go ahead and keep track of all of that. So an issue. One kind of a more market plumbing question, I guess you might say. Do we have the right kind of infrastructure to really help this market scale up? Do we have the right benchmarks, derivative markets, and so forth?
That's a great question. At the moment, I think that there's much to be done, both on the benchmarking side, and we see many initiatives that are really helping drive that through things like the Task Force for Climate-Related Financial Disclosures, as well as materiality mapping through things like SASB, and then very specific industry benchmarks as well, like GRESB and the real estate side. So we do see these initiatives, and these are playing a very important role. They're becoming far more important for bankers to be able to understand and benchmark where companies are as they're establishing KPIs. KPIs are encouraged to use science-based methodologies. They're also encouraged to look at kind of data that's been disclosed for the past 3 years. And so, if we're just getting companies to establish these KPIs now, they might not necessarily have a huge amount of meaning until 3 years' time. So there's a little bit of a lag here. So the more that we can do now to establish this, the better. In terms of infrastructure, in other senses, there's certainly much more that governments can be doing to help build out this market and to grow it to its full potential. One of the biggest roadblocks that we do see is around the potential cost of establishing sustainable debt, and essentially kind of persuading like issuers that actually it's worth any additional work they have to do. It's not a huge amount of work by any means, but if we do have to start getting confirmation or alignment to certain initiatives, if we have to start getting external verifications, if there's anything the governments can really be doing there to ease that cost, and that's also something that would certainly scale the market.
Dan, that was a tremendous presentation, and thank you also for allowing plenty of time to answer the questions. We'll have to leave it at that, but thank you very much for sharing your insights.